Bitcoin has logged its largest gains in percentage terms in about 6 months this morning. And at least for now, the rally is continuing, up more than 10% over the last 24 hours. I think it was at 10.5% last time I looked. There are a couple potential catalysts behind this morning's action. The first is that traders have been positioning themselves for things to get worse for Bitcoin before they get better based on current momentum. And a lot of people betting on lower prices had to buy as the price went up to cover those bets. It's a classic short squeeze scenario, and with more than $100 million worth of bets on lower prices being liquidated over just the past 24 hours, it's likely amplified today's gain significantly. But in the longer term, and to my perspective, more important as a story here is the big picture or macroeconomic sort of situation. Modern markets have long been addicted to what's referred to as supportive monetary policy, and which many traders in the U.S. have long called the Fed put. I think about it as taking pain pills. When you've broken your leg, they're really helpful, but once the leg is healed, and then you should probably stop because the medicine not only becomes dangerous, but it's highly addictive. Stock market valuations and to a lesser extent housing prices are one of the most visible ways that we measure the success of the economy and indirectly of how good governments and power are doing on economic issues. And these economic doctors at central banks, though, are much better at prescribing than they are at tapering the patient off when the need has passed. In economic terms, that's caused inflation to spill out of risk assets, where it's perceived as a good thing, and into the real economy, where it's making life increasingly difficult for all but the richest among us. It's only at this point that central banks somewhat recently have acknowledged that they even have a problem, and they're quickly moving to cut the patient off, basically cold turkey with historically large interest rate hikes. We just saw the ECB raise by 0.75 of a percentage point, which was the largest interest rate hike in history and represented more than a doubling of their core interest rate in a single day. Which again had never happened before. So markets don't want that. Markets remain addicted to this stuff. And the story that they're telling themselves is that, well, the doctor is going to start giving us the medicine again. And I don't need to actually make any changes in my life to accommodate what's going to happen because, hey, everything is going to be fine. There's actually a lot more to this story, but I think that this is probably a good place to hand it off to you, David. Where I want to go with this, though, is the dynamic between governments and central banks, specifically with Europe as a prime example. But we're seeing it really everywhere, and it's super important. Yeah. But before we get to that, kind of what's your take here?
Yeah, I mean, I should start off by making some humble noises, because I was definitely in the camp that believed this inflation wave was going to be transitory. And I think that ship has definitely sailed. I was 100% wrong about that. But having acknowledged that, whether I didn't read the ING report, so I don't know the exact contours of their argument. But if you're a person who is trading speculative assets on the expectation of a Fed rate hike in 2023, I mean, the word for that is delusional. In our industry, we call it hopium. I mean, it's not going to happen. If you look at the curve as the Fed does try to bend down U.S. inflation, we have gotten a little bit of a retrace, but I just don't think this trade reflects exactly how sticky inflation can be and clearly has become at this point, for one thing. And B, even if the Fed does manage to get inflation back down to 2%, which is a big job from where we are right now, which is, I think, 8.5 most recently. And you know, even if they do that, you then have to have a catalyst where they are motivated to drop rates again, which means probably a pretty huge recession, or at least a pretty sizable downturn. I mean, I think that the Fed I'm not going to say it's dead, but it is going to take some real necromancy to resurrect it at this point. And also the timeline on this trade is wrong. If you're longing Bitcoin right now based on interest rate moves next year, that's just not how it works. You're going to have to do that a lot closer to the actual date for that trade to work out for you. So, 10%. Great. And to be clear, we don't know 100%. You never know in a market what exactly is driving one day's action. And usually we can't even point to it. But I'm just going to put it out there that if your rationale for going long on Bitcoin right now is this idea that the trend in central bank action is going to reverse, you're riding the wrong train, I guess I'll say. Sandali, what do you think about all this?
No, I agree with you. I feel like it's kind of wishful thinking. It's very optimistic to the point where it's kind of hard to wrap my head around. I mean, sentiment has been so bad, like strongly bad, that Bitcoin bettors were gearing up for a short squeeze, as Adam said. I mean, we've seen the highest liquidation since the big mega crash on June 14th. And, every indication that we've gotten from central bankers around the world is basically inflation curbing measures. So I'm also interested to see like what the ING kind of based this kind of prediction on. But, it's cool that investors and markets can kind of rile each other up like this from time to time. So we all collectively go, what's going on? But I don't know, it's just another day in this crazy world. In the real world, it doesn't look like inflation is gonna die down anytime soon. So Adam,
I'll throw it to you, but one point on that real world thing. Another point against this thesis is that jobs are still coming in strong in the United States, at least. I mean, we don't have here a lot of indications that the real economy is trending against inflation either. So again, more reason to not expect what the market may be expecting right now. Adam, go for it.
Okay, so I am inherently a contrarian. I do not trust central banks. I do not trust governments. I think that they routinely misrepresent reality in ways that make them look better. And I think that with that understanding, it's somewhat easier for me to understand what's happening here than it is for a lot of people. So there's a couple of dynamics in play here. The first off is that nobody believes the Fed, but the Fed wants people to believe them, because to the extent that people believe the Fed is to the extent that they will then make changes today about what they think the Fed will do tomorrow, which is why it's so important to the Fed that people not think there will be rate decreases next year, because if they do, then they will start to reverse the trend today and undo all of the work that the Fed has done. Now, does that mean that the Fed won't actually reduce rates next year? No, it doesn't. They are actually making these decisions on almost a month-to-month basis. So there's zero guarantee that this will remain the same, and it's very due to conditions. And there are huge political considerations in this too, because although money is supposed to not be political, the reality of it is that the dynamics of money influence the economy in the ways we've discussed here a huge amount. And as a result of that, it means that especially as we get closer to the midterms, if the Fed continues on this path of historically aggressive interest rate hikes, they're effectively dooming the Biden administration's ability to do anything over the next couple of years. So that's my read on the situation. I think there's actually a non-zero chance that we see a reversal of this policy just for political considerations because of that. But again, the narrative is one or the other, right? But it's a question of who do you trust. The other dynamic that's really important here is that central banks are concerned about their credibility, and they want to bring down inflation. But that's something that is directly negative to the performance of an economy. And like I said, this is a political consideration, not just a monetary one. So in the United States, what that looks like is here's the Fed saying things are going to be worse for longer, right? And then over here, here's the Biden administration saying, hey, we're going to forgive between $300 billion and $1 trillion worth of student debt, which is very, very inflationary. And also they passed an Inflation Reduction Act, so-called, that adds a $1.5 billion worth of additional spending, which is inherently inflationary. That same dynamic is playing out right now, by the way, in Europe, where the European Central Bank had this historically aggressive rate hike where they more than doubled the rate. But at the same time, due to sanctions on Russia and the energy situation in Europe, where I don't know if people are paying attention, but energy rates there are up in some cases more than 1,000% so far this year. And it's basically made it so that governments are now bailing out and may, in fact, wind up nationalizing some energy companies, which means that although the central bank is tightening, the government is borrowing money. Governments around the bloc are borrowing new money and then spending it, which is very inflationary. So the central banks do not have a direct way to reduce inflation. They have an indirect way to reduce inflation by increasing the cost of borrowing money. But if governments on the other side are printing and creating new money for purposes of politics, right? Because if you have somebody whose energy bill was $300 and it goes up to $4,000, well, dang, that's not a government that you're going to be happy with, especially if it's not something that's actually hurting the sanctioned party anyways. So like I said, this is a really big topic. It's one of the most important things, in my opinion, in the world today. And that dynamic is the complicated factor. It's not just about central banks. It's not just about governments. It's not just about us. It's not just about money. It's about all of these things together. And the complicated soup that creates is a mess that nobody can predict. And because of that, there's just all this uncertainty and all this chaos around the world. So I expect that to get worse before it gets better, but it could be fixed very quickly, in Europe at least, by simply reducing the sanctions on Russia and allowing enough energy to come back into the bloc such that they didn't have to be bidding each other up with bailouts. But that's the situation today and seems unlikely to change. but we can move on.
Just to clarify one thing real quick, Adam, I mean, the sanctions on Russia are one thing, but Russia has also just started cutting things off. So it's not necessarily entirely flexible.